Hello, everyone, and welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today's Tuesday, May 10th. I'm Mike Bernick, and joining me today are David Dukevich and Mandeep Rai. All right, so let's go ahead and get started. Obviously, global stocks have had a little bit of turbulence over the last few weeks. In fact, really led by Asia, which dropped over 4% last week, and Hong Kong and mainland China both declining again. Actually, the NASDAQ has been declining here in the U.S. thanks to high-profile earnings misses by a couple of real popular companies, Apple a few weeks ago, Microsoft, as well as Google. So taking a little bit of the steam out of U.S. stocks. But overall, we're still very close to new 52-week highs. We'll have to see what the next month or two until the next Federal Reserve meeting comes up again. So let's go around the horn with our editors today. Mike Larson's out at the Money Show in Las Vegas, and so Mandeep Rai, we'll start with you.
And good morning, everybody. Yeah, so like you mentioned, we've had some lackluster numbers this earnings season. We're on track for an 8.5% decline in earnings, sales, 2.5% decline, and it's been the fourth straight quarter of consecutive declines, but the market seems to be continuing to grind higher, and it's kind of like it's trying to factor in changing conditions here. Oil's starting to rally a little bit. There's some swings on a day-to-day basis because of the Canadian wildfires, Saudi oil minister replacement, pipeline outages in Nigeria. And despite the high inventory builds, it's been rallying due to the expected drops in production, even when it's ever so slightly. So I think the commodity prices are starting to kind of impact favorably. The dollar has been helping, except for most recently when it's rallied a little bit. But I think all eyes are going to continue to be, the spotlight's going to be on the Fed and other central banks for their policy measures. And as long as rates stay low for longer and other central banks keep purchasing assets or charging for deposits, this rally can continue. Now, my expectation is that because we've been in a range for such a long period of time, since 2014, you're going to get, there's going to be some sort of a breakout, whether it's going to be to the upside or the downside. And now it's increasingly looking like it's going to be to the upside, and it's not based on economic fundamentals. It's not based on, everything is going great and all the expenditure that we've had in multiple rounds of QE and low rates for a long period of time is kind of, causing the economy to grow. It's just going to be based on, the Fed is still there, and even though we have slow growth and disinflation in much of the world, the Fed and other central banks are going to continue to be supportive. That's not the premise that you want for the economy, for the market to kind of rally. But we don't control the algorithms, and we don't control the sentiment of the investment and what drives them. So we could get a breakout to the upside, but I don't think that that's going to be something that you want to, load up on biotech stocks and other risky stocks, but I think it's something that you fade because I think there will be a day of reckoning. I think the over-indebtedness and then, the growth is scarce, so it's going to set us up for a day of reckoning sometime in the future. Yesterday's China data showed inflation was steady. Producer prices beat expectations, and retail sales will be out later this week. China had been the white knight previously with its demand for raw materials, and but now, because of its transition to a more consumer-led economy, its demand has waned, and it's been more of a source of disinflation for the economies it once helped. So anytime we see China on the ropes, the rest of the world feels it from an economic growth standpoint. So I would continue to watch what's going on in China and continue to watch what's going on with oil prices and commodity prices. The dollar is going to be the key, and the largest impact of that is going to be the perceived expectation for rate hikes and tightening here in the U.S. So continue to watch the economic data. One other thing that you want to potentially look at is the valuations in the market and even in the non-public world of technology. These so-called unicorns, there's about 88 of them, and these are companies with valuations of $1 billion or more. And there's been some ripples in those stocks, in those companies. 9 of the 88 companies have had changed CEOs in the last couple of months. Many are experiencing layoffs, valuations are decreasing, and mutual fund and private equity investments have been waning and have been taking write-downs of some of the valuations of these companies. That's not something that's good in terms of the overall expectations for tech. Tech has been, like you mentioned at the top of the call, has been a source of rather than a source of weakness in this earnings season, rather than a provider for the opposite side, as it has been in the past. So it's joining energy, materials, financials, and now we have technology also that's showing a decrease in earnings, and that's kind of concerning. So we're keeping a pulse on what's going on there as well. But it's overall it's kind of concerning at the moment as well.
All right, thanks, Mandeep. Appreciate your insights there.
Yeah.
David Dukevich, how about it? Mandeep mentioned that the markets sooner or later are going to face a day of reckoning as we see the central bank policy going into zero interest rates, and at the same time 4 straight quarters of declining profits. What's your take? We've seen a pretty nice rally, certainly in commodities recently.
Yes, we have. Hey, everyone. You're right. Commodities has had a pretty strong move, and if we look just at gold, on a short-term basis, we are starting to get more of a weakening or more of a bearish technical picture on gold, and it's really starting to come back into a critical support area right now. From mid-February up to late April, almost into last week, we were seeing the gold form a bullish triangle pattern, and then we did break above that last week. And now we're coming right back into where we're actually testing that high side on the triangle on that support level. So this 1265 level that we're sitting at right now is going to be very critical to see. If we can hold here, we might be able to break up to new highs again. If not, there are some warning signs that look like we could be pulling back here again. One of the warning signs I would say first is on a technical picture. We're seeing a bearish momentum divergence when you look at the 14-day RSI. Gold hit a new high just last week, but the momentum RSI indicator failed to confirm that because it registered a higher level back in February. So that divergence in itself is a sign of a weaker market. Also, as I mentioned before, we're retesting this breakout point, so that's another sign that we really got to hold here, or we could see a further pullback, basically having a bull trap on this breakout. And then the third to look at would be the dollar. So far, it's had a good couple weeks now where we've really started to rebound here. So that's a key thing to watch as well. If we can get some more momentum and see the dollar move higher, that will be very bearish for gold, at least in the short term here. So we're watching that. Now I would say that's similar pattern with silver right now. When you look at some of the other commodities, oil is trading, bounced up to get over $46. It has pulled back, but it is in a support range here around that $43, $44 level. It wouldn't surprise me if we saw a little bit further of a pullback to retest even $40 on the downside. You could even go a little bit further than that, get maybe into that $36 to $38 range, but I still think that's probably where we're going to see it fall to at the most before we try to push higher again, maybe as we get later into the summer here. Today we also get the WASDE report, the May monthly grains report, so we'll see what that can do. Right now, grains have pulled back, specifically corn and wheat, and are retesting some of their breakout levels. Soybeans has held up a little bit better, but I think after we see the May report come out at noon today, we'll get a new direction in those markets as well. Natural gas itself has been holding up quite well. It's still trading around $2.15. I think we could see that push to maybe the $2.25 level, and then maybe even push up to the $2.50 level here. So I still think there's some room to go in natural gas as well. You mentioned in the markets, stock markets, we've been holding up near highs, and I think really what's been keeping the market up there without really breaking down at this point has been the earnings numbers. Even though we're down, I think Mandeep mentioned about 8%, but 70% of the companies that have reported have been beating their lower expectations. So I think that news has been enough to just keep most of this market propped up here temporarily. We've seen volatility continue to stabilize. The VIX is now back under 15. Until we see that start to move a little higher, I do think we're going to see the markets kind of churn at these levels a bit. But there are a lot of warning signs that we should start to see a pullback here. I agree with Mandeep when he said you do want to kind of fade into any rallies that we have, because I think the risk right now is to the downside on the markets.
All right. Well, thanks for that update. We'll certainly keep an eye on those key levels you mentioned in gold and commodities and stocks as well. Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you, one and all, and be sure to tune in again next week. Until then, I'm Mike Burnick for Money and Markets. Good investing.